Hello, everyone, and welcome back from our 2-week hiatus as NCPERS hosted our first ever virtual NCPERS accredited fiduciary program over the past 2 weeks. That program has gone very well, but we're very eager to restart our regularly scheduled webcasts. And we'll start today with a session on COVID-19, the impact of the economic disruption on pension plans. My name is Hank Kim, and I'm the Executive Director of NCPERS. Today's program is part of our Center for Online Learning. As we all adjust to the new COVID reality, please bear with us if there should be any technical issues or unplanned background noise during our webinar. As always, your patience and understanding is appreciated. We encourage audience participation. Please submit questions by using the GoToWebinar portal. However, to ensure that we can cover all our topics, we will hold your questions till the last part of the program. Additionally, in the handout section, you will find a PDF of today's presentation. Today's webcast is sponsored by JP Morgan Asset Management. To introduce his firm and today's webcast, we have David Leibowitz. David is Executive Director of the Global Market Insight Strategies team. In this role, he is responsible for delivering timely market and economic insights to clients across the country. Since joining the team, David has helped build the Market Insight program in the United Kingdom and Europe, as well as coordinate the team's global research and publication strategy. David, the webcast is yours.
Great, thanks, Hank, and good morning, good afternoon, everybody. Thank you for joining. So if we jump to page 2 of the deck here, I just want to start with a couple of comments around JP Morgan Asset Management as a firm and some of our long-standing relationships and partnerships with public sector retirement plans. As Hank mentioned, my name is David Leibowitz. I'm a global market strategist here at JP Morgan Asset Management. And before starting today's session, I just want to start by saying that I hope you and all of your families and colleagues are keeping safe and more importantly, keeping sane in what we've found in this new reality of social distancing and self-quarantine. It's truly been a tough period of time. I think that my productivity levels are certainly up relative to when I'm in the office. And we really are all in this together. And I think that that's important to keep in mind, particularly in light of some of the events over the course of the past couple of days. Despite these changes in how we interact, however, know that all of us at JP Morgan Asset Management remain committed to helping you and your organization, more importantly, make informed investment decisions. And we're really just trying to maintain the high standards of service that you expect from us. What I'd say is over the past couple of months here, I have been on the phone essentially nonstop with clients, sharing our views around the impact of COVID-19 on the economy, sharing our views on the impact of COVID-19 on the capital markets, and trying to be truly a trusted partner and an advisor when it comes to asset allocation and portfolio construction. So in general, our teams remain fully equipped to continue delivering these insights via webcast, phone, other digital mediums. I've gotten pretty good at Zoom here over the course of the past couple of weeks. And what I would say is our website, which is www.jpmorgan.com/institutional, is updated daily with a catalog of recent pieces, not only on the investment implications of COVID-19, but really more broadly with our best thinking across asset classes. If there's anything you'd like more information on or would like us to consider writing about, and as the person who does a lot of the writing, I'm very open to this, please don't hesitate to reach out to myself or your JP Morgan client advisor. I've been doing the macro strategy thing for a decade now, and oftentimes the best pieces that we put together are those that really come out of client conversations or specific client questions. So with all that said, let's move on to the next slide in the deck and dive in headfirst to today's discussion, which obviously centers on COVID-19 and the impact of this not only on the global economy and the capital markets, but more importantly on public pension plans. So in terms of the roadmap for today, I want to start by talking a little bit about what we're seeing with respect to global growth, I then want to hone in and provide some comments as to our expectations with respect to the United States specifically. At that point, I will move on and talk a little bit about the risks that exist relative to to our base case view, and then talk about some of the policy response that we've seen on both the monetary and the fiscal side. At that point, I'll switch gears. I'll talk a little bit about what we think this means for interest rates, what we think it means for fixed income more broadly, and then wrap up with some comments around equity markets, real estate, infrastructure, core real assets, and how we're thinking about building portfolios, with one eye on what's happening here today, but another eye on what potentially might lie ahead. So what we're showing here on this first chart are the purchasing managers indices for services, or the service sector PMIs. Now, I'm sure a lot of you are familiar with our guide to the markets and probably familiar with the PMI heat map that we have had in the guide for quite some time. We did make the change at the end of the first quarter, and historically we've shown the manufacturing data, but we did change things up to focus more on the service parts of the economy, because by our lights, that's where the impact of COVID-19 is really going to show up in the most significant type of way. So just as a refresher on this chart, green means good, red means bad. 50 is the level that separates expansion from contraction. And when you look at the far right-hand side of this chart, you can see the sharp deceleration in service sector activity that's been observed here over the course of the past couple of months. And, we've been of the view for quite some time that this downturn was going to hit its worst during the second quarter of this year. We didn't really have a good sense as to whether it was going to occur in April or June or May, but we were relatively confident that the second quarter would mark the low point in terms of global economic activity. And that view, to an extent, has been validated over the course of the past couple of days. We got final PMIs for the month of May just earlier this week, and the April numbers, as you can see on the chart, were absolutely terrible. What I would say about the May numbers is that, frankly, they looked less worse. Less bad, I should say. And so, that does provide us with a bit of confirmation that the clouds are gradually starting to break here with respect to the outlook for the economy. When we look at some of the other higher frequency indicators, things like mobility indicators, stringency indexes, credit card data, which we've gotten a scrubbed version of that, which has been quite informative in terms of tracking consumption patterns and spending in real time, it does feel like things are gradually coming back online here. So, we still are forecasting a 40% annualized decline in real GDP for the second quarter as a whole, but things in May seem to be getting a little bit better, and things in June will hopefully continue that trend. In terms of our expectation for the coming quarters, however, I think that this is going to be somewhat of a square root shaped or swoosh shaped recovery. We're expecting a decent sized bounce in growth during the third quarter, but to an extent, this is a function of the mathematics, right? We stopped the economy in the second quarter. We're starting it back up into the beginning of the third quarter. So naturally, activity will show a bit of a lift relative to 2Q. But, we don't necessarily anticipate that big bounce to be sustained into the end of the year and the beginning of 2021. We think that economic growth will remain positive over the coming quarters, but it's going to be a bit more muted than what we would see in a normal environment. So, when we think about the order here, we think about a 10% bounce in growth during the third quarter, and then growth between 3 to 5% in the fourth quarter and into the beginning of 2021 with respect to the US specifically. So short but deep is very much our base case view when it comes to the direction of travel for not just the US economy, but the global economy over the coming months. If we flip to the next chart and think a bit more about the United States, the chart on the left-hand side is one that I think a lot of you are probably familiar with. What we're showing there is the year-over-year change in real GDP. We show two dotted lines on this chart. The one dotted line, which extends for the entire graph, represents the average growth rate in the US economy over the past 50 years. And that shorter blue dotted line represents the average growth rate in the US economy since June of 2009, so since the financial crisis ended. Now, the chart on the right shows a breakdown of US GDP, and I think what is relatively clear is that in the US, we really depend on the consumer for growth. And so a lot of this is going to depend on how quickly the consumer can really heal. I'll touch more on the labor market in just a moment, but one of the complicating factors right now is, for the better part of 2019, we talked about how the United States was somewhat insulated from trade tensions with China because we're not really a manufacturing economy. We don't make a whole lot of stuff. We rely on services, and services are inherently local. Well, now this is very much cutting the other way, and given that this downturn is really concentrated in services, we do expect countries like the US and parts of Western Europe to see a disproportionately large impact. And it's because we rely so much on the consumer, and more specifically, the consumption of services. So when we think about the direction of travel here, again, we're not necessarily anticipating the type of V-shaped recovery that you would usually see coming out of an economic downturn. Now, obviously, markets have been participating in their own version of a V-shaped recovery, particularly the U.S. equity market, and I'll touch more on the outlook for equities later on during the conversation. But I'm not necessarily sure we're going to see this big V-shaped recovery in the economy, and that obviously has implications for the state of affairs with respect to state and local budgets, with respect to the outlook for revenue, and it just kind of adds an additional complicating factor when we think about the direction of travel here, particularly at the state and local government level. So, what could impact our base case view? What could undermine or change, our expectation that we are going to see this kind of square root shaped or swoosh shaped recovery, which by historical standards is going to be more gradual than what we usually see? Well, if we flip to the next chart, in terms of what could go right, if we were to see the premature development of some sort of vaccine or the widespread distribution of some sort of antiviral or rapid testing kit, that would allow the economy to come back online much sooner than what we're expecting. And I think that would likely lead to a pretty significant rally in risk assets, as well as an increase in interest rates. Not necessarily a huge increase in interest rates, but definitely see them move off of the levels that they've been stuck at over the course of the past couple of weeks. That said, it does feel like the majority of the risks here are tilted to the downside. The first big downside risk that we see has to do with the potential for a second wave of infection. I think that I was becoming of the view that perhaps this was not as big of a risk as people felt it was in the initial stages of the economic lockdown. But watching the protests across the country over the past couple of days and kind of seeing these mass congregations of individuals, I do think that the risk of a second wave of infection has likely increased here. A lot of the pictures that we're seeing, a lot of the things that we're reading do suggest that people are wearing masks and they're taking this seriously, but there's nothing socially distant about congregating in a specific location with hundreds, if not thousands, of other individuals. The second big downside risk that we see, and this is really reflected on this chart here from our guide to the markets, has to do with the labor market. And what we're showing here in gray is the unemployment rate. What we're looking at in light blue is wage growth, and you can see that the unemployment rate jumped to a level of 14.7% in April of this year. I don't think the unemployment rate is done going up. I think when we get the May numbers at the end of this week, we will see an unemployment rate that's probably a couple of percentage points higher. But the reality of the situation is I don't necessarily care all that much about where the unemployment rate goes in the short run. I care a whole heck of a lot, however, about where the unemployment rate settles as we get to the end of this year and the beginning of 2021. And if the unemployment rate goes up to say 20% here, and then is back down into the low teens by the end of 2020. What that says to me is that the economy is coming back online and is successfully reabsorbing this labor market slack that we are currently in the process of creating. If the unemployment rate goes up to 20%, however, and then fails to come down in any meaningful type of way by the time we get to the end of this year or the beginning of next, that's going to make me a bit more uncomfortable. What that's going to suggest to me is that there's been more damage done to the underlying economy than perhaps a lot of people were expecting. And as a result, the duration of this downturn is going to be extended relative to what a lot of folks have currently penciled in. I think that, if we were to see a failure or an inability on the part of the labor market to reabsorb these workers with any sort of pace, I think that could potentially undermine the current levels that we're seeing the equity market trade at. You could very well see interest rates remain low, long-term interest rates remain low in that type of environment. And importantly, from a corporate bond perspective, from a spread perspective, I think you would likely see spreads widen back out as it became more apparent that the underlying stress in the economy was perhaps more significant than a lot of people believed. And so with our focus on a lot of these issues that we just discussed, understanding the policy response is increasingly important. What we're dealing with from a fundamental standpoint here is a cash flow problem, right? Businesses have no revenues and consumers have no income. And so what the fiscal response is really meant to do here is provide a bridge between where we are today and the point at which the economy will come back online, which in our view is some point later on this year. So if we flip to the next chart and start by talking about the fiscal response that's been observed over the course of the past couple of months, what we're looking at here on the left-hand side are just the major tenets of the fiscal response that's been implemented since the onset of COVID-19. And you can see that this is primarily focused at supporting the consumer and then supporting small businesses. So in terms of supporting the consumer, this has been done through one-time stimulus checks and a version of enhanced, expanded, and extended unemployment benefits, which are currently set to expire at the end of July. On the small business side, this has been done through the establishment of a variety of different lending facilities, one of which, the Paycheck Protection Program, as I think we all know, has been fully tapped and subsequently refilled. And so you add all of this together, and what we've seen is about $2.4 trillion of fiscal stimulus announced over the course of the past, call it 2.5 months. And the question that I always end up getting is, will this be enough? And David, do you think that there's the likelihood that the federal government does more? And I think the answer is no, this is not necessarily enough. And as a result, yes, I do think that there's more stimulus coming here over the course of the coming months. Now, I do think that this stimulus will be relatively targeted. I think that, frankly, the $3 trillion HEROES Act, which was passed by the House, is probably dead on arrival in the Senate. But I do foresee the potential for another, call it, $1 trillion of fiscal stimulus between now and the end of the year. And I think that that'll really be used for two things. One, it'll be used to extend unemployment benefits, I think probably through the end of 2020. And then I also think that a significant portion of that will be directed towards state and local governments, because as you can see on this chart, they for the most part have been left by the wayside during the rounds of stimulus that we've seen implemented up until this point. The charts on the right-hand side just show us what we all know, is that there's going to be a significant impact here on both the debt and the deficit. Longer term, this debt issue we're going to need to deal with it because, frankly, it's becoming untenable. And while I do subscribe to the theory that when debt levels around the world are rising, it's oftentimes about having the least dirty shirt. I do think we're looking at higher individual income taxes at some point down the road. That was what the federal government did after World War II, which you can see is the last time we saw a debt build of this magnitude. But furthermore, individual income taxes are where the federal government derives the lion's share of its annual revenue. And so I think that that's a much easier lever to pull than necessarily increasing things on the corporate side. Now, does this happen in the next couple of years? I think a lot of that depends on the outcome in November, but I am relatively confident when I say that in the next 5 to 10 years, I do think we'll be seeing higher taxes, probably not just here in the US. I think that, frankly, this could end up being a bit of a global phenomenon. So the fiscal response has been significant, but arguably somewhat insufficient. If we flip to the next chart and think about the monetary response, this is where I have been nothing short of impressed. I cannot even begin to describe the number of client conversations that I had over the past couple of years where, I'd go into an office and we'd sit down and exchange pleasantries and talk about growth and talk about the Fed. And when we would get to the Fed, people would tell me that, well, there's nothing the Fed can do the next time around. They're running out of things to do. They're just going to drop rates back down to zero. They're going to restart QE, but frankly, I don't really see what other levers they can pull. And yes, the Fed has dropped rates down to zero here. Yes, the Fed has restarted quantitative easing, but importantly, they've put no limit on the amount of quantitative easing that they can do. They've added things like commercial mortgage-backed securities to the list of assets that are eligible for purchase as part of the QE program. And then you move on and you're reminded of this laundry list of facilities that have been set up in an effort to support lending to small businesses, larger businesses, and state and local governments at that. And I think one of the most interesting things about what the Federal Reserve has done here over the past couple of weeks with respect to state and local governments and municipalities specifically is they've really kind of opened up the war chest. And the municipal liquidity facility, my understanding is that it is still in the process of getting up and running. But at the end of the day, that should really be a key tool that allows municipalities and state and local governments to address any operating deficit issues this year. I think that there are still long-term funding issues that we're all aware of, and I'll touch on that with respect to the capital markets in just a couple of minutes here. But the short term, I think that the Fed has, to an extent, ridden to the rescue, and in concert with additional fiscal stimulus, hopefully this will provide sufficient support, again, for municipalities and state and local governments to bridge this cash flow gap that they are currently facing. So in terms of our expectation for rates here, if we flip to the next chart, we do foresee interest rates, particularly on the short end of the curve, staying lower for longer. The prior chart highlighted that futures markets are pricing in the Fed funds rate remaining around zero over the course of the next couple of years. I would be of the view that Fed funds is probably staying at zero, barring some sort of inflationary shock, at least through the end of 2021, if not into 2022. But I do think that there's room for long rates here to pick up and potentially for the curve to start to re-steepen. Now, I mentioned that we are of the view that there's not going to be a big V-shaped recovery, and so I don't think all of a sudden you're going to see long rates back where they were at the end of 2013, as we illustrate in this chart. But you could certainly see the 10-year, the 30-year move up off of their current levels and allow that curve to re-steepen. So, I think that this creates a somewhat interesting dynamic here, not dissimilar from what we saw in the immediate aftermath of the financial crisis, where short rates remain low and there's really no rush to adjust things from a policy perspective. But long rates begin to trend higher as activity data begins to improve, and as importantly as inflation gradually begins to normalize. And we think that there's opportunity in fixed income that's been created. I recognize that from an absolute standpoint, yields are still at historically low levels. But if we flip to the next chart, some of the spread widening that we've observed over the course of the past couple of weeks and months more broadly has really created an interesting opportunity within corporate credit and various parts of the securitized market. So I mentioned earlier that I'd have these conversations with advisors and investors, and they would say to me, look, the Fed is out of bullets. I don't know what they're going to do. And when it comes to fixed income, I'm just going to barbell between treasuries, which obviously provide us with protection, and then parts of the bond market that provide us with a bit more income. And we frankly saw a lot of people embracing things like high yield as a way of addressing that income shortfall. Now, this chart here, the position of the diamonds relative to the x-axis represents their correlation to the S&P 500. The position of the diamonds relative to the y-axis represents their average yield over the past 12 months hedged back into US dollars in the case of those international markets. And, again, a lot of people were looking in the bottom left-hand corner, they were looking in the top right-hand corner, and when they rolled up that barbell approach to the portfolio level, they ended up with the risk-return trade-off that they were looking for their fixed income to provide. We still think a barbell approach makes sense. We still want to own treasuries. We've been getting a lot of questions, particularly from our clients on the public pension side, around why would you even bother to own high quality sovereign bonds at this juncture. And we recognize that they don't really provide you with any income, but we simultaneously recognize that they do provide you with protection. And a 60-40 stock bond portfolio outperformed an all equity portfolio from the peak to the trough this year by nearly 15 percentage points. And that was really due to an allocation to high quality core fixed income. So we still think that basing portfolios in fixed income portfolios in things like treasuries is a relevant approach to take and an appropriate approach to take going forward. But rather than reach all the way down the quality spectrum into things like high yield, we're much more comfortable operating in the investment grade corporate market, the asset-backed securities market, the mortgage-backed securities market. And it's not only because we like the idea of focusing on higher quality assets here. More importantly, it's driven at the same time by this idea of wanting to follow the central bankers and being comfortable buying what the central banks are buying, because although things like investment grade corporate bonds do add a bit of equity risk to your overall portfolio, we think that some of that is effectively tempered when a central bank is engaging in asset purchases within a given sector or market more broadly. So fixed income still about a barbell, but a higher quality barbell at that. If we flip to the next chart here and think a little bit about private credit, a lot of conversations leading up to the downturn, people were reaching for yield and they were trying to find income wherever they could. Now, I think that this chart illustrates some of the enthusiasm, or helps to explain some of the enthusiasm around private credit, particularly direct lending, over the course of the prior cycle. And what we've done here is looked at the returns of different parts of the bond market, depending on what was happening in the economy. And we've used the ISM Manufacturing Index as a proxy here for whether the economy is expanding, contracting, so on and so forth. And when you look at that purple bar, which represents direct lending, it kind of looks like a silver bullet, right? It keeps pace with low quality assets during periods of expansion, and it outperforms those low quality assets during periods of recession. And so why wouldn't you want to load up on an asset that seems to perform well regardless of the economic environment? I do think that this led to a bit too much growth in terms of assets, in terms of managers. Direct lending funds that are coming due right now are certainly facing a pretty steep hill and a pretty significant number of underlying challenges. But at the same time, for funds that are just launching or in the process of being launched, there is an immense opportunity out there. And if nothing else, when we talked earlier about this being a cash flow problem, people need financing. And the private markets have really grown in such a way that people can now go to those private markets for financing rather than being forced to rely on traditional banking channels like they have been in the past. And so I think that private credit will remain a significant area of focus for institutional investors more broadly. But we do continue to warrant a decent amount of caution here, and we are of the view that manager selection, particularly in this space where there's been such rapid growth over the course of the past decade, is most likely of the utmost importance. So flipping to the next chart here and thinking a little bit about the growth asset side of the equation, there's a lot of enthusiasm in the equity market right now, to put it lightly. And pretty much every day, clients ask me, they say, David, how can the equity market be so disconnected from the underlying fundamentals, and don't things need to recouple at some point down the road? Now, I think for a lot of you that are tuned into this webinar, you've probably welcomed the rebound in risk assets and growth assets that's occurred over the course of the past, call it 8 weeks. That's obviously helped to bring funded status back to better levels, was the case at the low points in March. You're probably asking yourself, what's going on here, and how nervous should I be about another significant pullback in the equity market? Well, the first thing I would say is that the equities are anticipating a V-shaped recovery in corporate profits, and I do think that could be a pain point, or at least a source of volatility here in the weeks and months to come. The chart on the left-hand side here in green looks at earnings recessions. The blue bars represent consensus analyst estimates for earnings at the end of the next couple of years, and you can see that on average it takes around 3 years for earnings to get back to a high watermark after following an economic downturn. Yet you look at the consensus estimates over on the far right-hand side, and the expectation is that we're going to be back at an all-time high at some time, by the end of 2021. Now, I just don't really see that happening. I think we'll hit a new all-time high in earnings in 2022, but the end of next year does feel a bit premature from where I sit. So if that's the case, then why is the equity market hanging in there? Well, a lot of it has to do with the underlying sector composition, particularly of the S&P 500. And when we look at the chart on the right-hand side, what we can see is that not all parts of the equity market are dealing with this downturn in the same way. You've got things like technology and consumer staples and healthcare that are actually faring relatively well. And then you have things like energy, consumer discretionary, and industrials, where the bottom is just completely falling out. And so, one of the things that's happening here is that obviously technology is a large part of the S&P 500. Part of the fact that, or part of the reason why the equity market has been able to weather the storm relatively well is because technology is a big share, and as we can see in this chart on the right-hand side, technology is not getting hit particularly hard. The other thing that I think is going on is there's a massive amount of skepticism around this rally, and every time a client says to me, the market should be selling off here, I say to myself, well, if everybody's expecting the market to sell off, doesn't that mean that this rally can just keep on going? And when you look at positioning of the big systematic funds, when you look at the sentiment surveys, when you look at things like put call ratios, nothing looks terribly out of whack. Put call is giving us a little bit of pause here at the current juncture, but street positioning is net short, bull bear spreads are not out of whack. And so I do think that there is room for this rally to continue. At some point, we will see things roll over, but I'm not sure that that's necessarily lurking around the corner. I think you would need to see something actively go wrong rather than what we've been seeing, which is that the data in general is getting less bad, and the market seems particularly focused on direction rather than level, at least here at the current juncture. So if we flip to the next chart here, there have been a lot of questions around international investments, particularly over the prior cycle, and obviously the dollar played a significant role in dictating the performance of international equities and fixed income over the course of the past 10 years. You can see over on the left-hand side, the dollar did strengthen during that initial bout of risk off back in March. It's since come off the boil, but is still elevated relative to the levels seen over the course of the past couple of years. Frankly, in the short run here, I think the dollar is going to be a victim of the headlines. And I think if you continue to see a slowdown in COVID cases, if you continue to see success when it comes to reopening various economies, and importantly, you continue to see the fiscal and monetary taps remain running, I think that the dollar probably remains range bound, maybe even gets a little bit weaker. But if we were to see a big spike in cases, or a big disruption in terms of the economy, I think that would lead the dollar to appreciate quite notably. That said, longer term, we maintain our view that the dollar should weaken over the next 10 to 15 years. I sit on our company's long-term capital markets assumption committee, and we've kicked off that process for 2021. And we were having the dollar conversation the other day, and because the U.S. runs a current account deficit, as we show in the chart in the top right-hand corner, we are a net borrower of dollars from the rest of the world, and we do think that over the long run, that should put downward pressure on the dollar relative to what's been observed over the course of the prior cycle. So that dollar weakness in the long run, if we flip to the next chart, should again be a tailwind for international assets. And you can see over on the left-hand side that earnings have rolled over really across the board. It doesn't matter which equity market you're looking at, earnings have come under pressure regardless of where in the world you are most focused. But what I find quite interesting here is that, and you can see this on the chart on the right-hand side, valuations haven't necessarily re-rated accordingly. And you can see the US equity market over there on the left-hand side looking quite expensive at north of 21 times forward earnings. You look at Europe looks kind of expensive as well. And then on the right-hand side, you see Japan and emerging markets, which both look cheap. Now, in the case of Japan, I think, frankly, sometimes things are cheap for a reason. But in the case of EM, we do see a pretty attractive long-term structural opportunity there. We not only think that there's going to be better economic growth, better demographics, higher productivity, and that should all lead to more robust equity market returns than what's necessarily available in places like the US. When we compound that with where valuations stand today, we really see something that we think clients should be taking advantage of. So, when we think about building global equity portfolios, we're really of the view that a barbell approach makes a whole lot of sense, not dissimilar from what we're thinking when it comes to fixed income. And we want to lean into the US equity market because it is the highest quality equity market in the world. But we want to have some cyclicality in portfolios so we can participate as markets do trend higher. And our preferred source of that cyclicality here at the present is most definitely emerging markets, particularly Southeast Asia, and within Southeast Asia, service-oriented businesses rather than commodities and manufacturing. So that's how we're thinking about the public markets here. I know I touched a little bit on private credit, but I want to return to something I said earlier about clients asking us, why should I own high quality fixed income? Why should I own fixed income at all? If my portfolio, if I've kind of hedged out as much of the liability risk as I can using fixed income, why would I bother owning bonds? And where else can I find income, importantly, without materially adding to the overall equity risk of my total portfolio? And more and more, particularly in the public space, we're seeing people take advantage of things like core real assets, most specifically real estate and infrastructure, as a way of adding to their portfolio's overall yield, again, without materially increasing the equity beta at the portfolio level. And if we flip to the next chart, real estate is an area that has been quite significantly impacted by COVID-19. Actually, I work on our guide to alternatives, which I presented at a conference, I think last year when we were all together. We just are in the process of finalizing those updates today, and the book actually comes out tomorrow morning. So please, keep your eyes open for that email. And then more importantly, I'll be doing a webcast next Tuesday with the CIO of our infrastructure business, which I think will be a pretty interesting conversation. But looking at the updated numbers here, we have seen cap rate spreads widen out. So from a valuation perspective, core real estate in the United States is looking more attractive than was the case at the end of last year. And a lot of the trends that were in place beforehand, remain quite firmly in place at the current juncture. I think, if nothing else, this whole experience kind of accelerates and boosts existing trends rather than bringing new themes into play. And one of the questions that we keep getting has to do with the ability of tenants to service their rents, right? What's the risk that people stop paying and my income stream dries up? What we've seen thus far, and we actually have a chart that looks at this in our new guide to alternatives, is that most sectors have not seen a material decline in rental payment. It's really just been retail, where there were problems to begin with, and frankly, those problems have been exacerbated as both freestanding retail and malls have been shut down in the wake of this COVID-induced downturn. But if we flip to the next slide, as I was saying, we really do think that this accelerates trends that were very much underway, and two big themes for us, really three big themes, have been change in the office sector, headwinds to retail, and tailwinds to industrial. Now, the chart on the left-hand side here, it looks at the share of office space in the United States that is flex space. And you can see that number had been steadily trending higher over the course of the past couple of years. And when we look at flexible office space penetration relative to other markets like London or Shanghai, the US is on the low end of that range. And so I think that, again, this was a trend that was very much in place before this COVID-induced downturn. And as we look to the impact of this on the office sector specifically, I think you're going to see even more flex space. I think you're going to see small tenants directly negotiating leases with landlords. And importantly, when I think about somebody like myself, who's worked for JP Morgan in New York City for a decade now, I do think that we will continue to have office space, but I think that office space will change. I think I will always have a desk that I can sit at within a JP Morgan building, but I think that desk might change every day. And I think that in general, we are going to see increasingly flexible workspaces, even if that's occurring within a given corporation. On the retail side, we know retail was struggling. The chart on the right, the gray bars represent the share of gross leasable area, and then the blue dots represent retail sales growth over the past 5 years. And you can see that department stores, which account for the most leased area within retail broadly, have also seen the worst sales. And so there's just a huge mismatch here when it comes to retail in terms of how the space is used versus where the growth exists. We had seen a lot of success as retail establishments had increasingly oriented themselves towards services and experiences rather than traditional goods and stores. I think that that's going to be challenging going forward, but we do see retail continuing to evolve and actually becoming to look something a little bit more like a retail industrial hybrid. I'm a big believer that retail establishments will also begin to serve as last mile distribution centers because of their proximity to major population centers and also the space that is frankly available within these properties more broadly. And that really leads me to our final theme on industrial, which, I mean, you thought e-commerce was a big and growing share of retail sales before. Just think about what it is today and what it's going to be in the aftermath of this experience. I don't see demand for industrial properties waning anytime soon. That said, I do think we are going to see increased demand at the very low end of the range and the high end of the range. So people are going to want small industrial properties and then very large industrial properties. There is a bit of a glut in kind of that mid-sized industrial warehouse space because they don't necessarily serve the purpose that people are looking to industrial assets in an effort to achieve. So real estate remains a key area of focus for us when it comes to both diversification and income. And on the next chart, another area of focus within real assets is core infrastructure. Now, we've had a lot of conversations with clients around infrastructure over the past couple of years. And frankly, what we were seeing was folks reach for private equity like returns and really embrace higher risk infrastructure strategies. Where we stand at the present is we're of the view that a low risk approach to infrastructure has made the most sense and continues to make the most sense. We like things like utilities, contracted assets. We do find opportunities in trade terminals and airports from time to time, but that's not really the governing philosophy when it comes to the way we think about using infrastructure within the context of a diversified portfolio. As we show on this chart, which breaks down returns into their component, their income component and their capital appreciation component. Part of the reason why we like infrastructure so much is that steady stream of income that these assets historically have provided. And look, infrastructure is going to have to prove its worth. Low risk infrastructure is going to need to do what they've said they can do here over the course of the next couple of quarters. But as we look ahead, we think that the impact on things like utilities and contracted assets should be relatively minimal. And more importantly, they can serve as a fixed income substitute, for lack of a better term, as we think about assembling diversified portfolios over the years to come. So just wrapping up here with a couple quick comments on volatility and then portfolios more broadly. On the next chart, look, I don't think that volatility has run its course. I do not think we are out of the woods quite yet. I know that markets have been ripping here over the course of the past couple of weeks. There will be a pullback at some point going forward, but I think it's important to remember that volatility is normal, and importantly, equity markets are resilient. As we show on this chart, where the red dots represent the peak to trough decline for the S&P 500 each year back to 1980, and the gray bars represent the full calendar year return, there has never been a bear market in the US from which we have failed to recover. Sometimes it takes a little bit longer than others, but we always manage to get our money back and see things move upward and onward to new all-time highs. So there could be volatility in growth portfolios going forward, but what I would say is that, look, volatility is normal, and we will see equities get back to their all-time high. It's much more a question of when. And so on the final slide here, page 18 in the deck, at the end of the day, we're really continuing to advocate for a balanced approach to investing. We do think, however, that portfolios need to have three sleeves. They need to have one sleeve which provides them with protection, and that's going to be stuff like treasuries and a bit of cash that zigs when the equity market zags. On the other end of the spectrum, you're going to need a growth sleeve in your portfolio in most cases, unless you're fully funded. And that growth sleeve is increasingly becoming an income sleeve as well, because a lot of things like high yield investment grade corporates, right, they do have a positive equity beta. They will add to the overall volatility of your portfolio. And so what's emerged in the middle is this third sleeve, and this third sleeve is really best filled with uncorrelated income producing assets, things like real estate and infrastructure, which again provide credit-like streams of income, but have exhibited a negative correlation with both stocks and bonds over the course of the past 10 years. So portfolio construction is becoming more complicated. There are more levers that we're thinking about pulling as we build diversified portfolios. But if I would say nothing else, the impact of COVID-19 is not here today and gone tomorrow. I think that equity markets are a bit ahead of themselves. We talked about some of the longer term, more structural themes with respect to the labor market, the outlook for rates, and how we're thinking about portfolios. And I do believe that the prudent investor will keep their eye on those longer term trends rather than get caught up in what's happening here in the very short term. So with all that said, I'd like to thank you very much for your attention this afternoon. And with that, I'll pause and Hank, turn it back over to you to see if there are any questions from the audience.
Great, thank you, David. Thank you for that great presentation. There are several questions. First is, at the beginning, you'd mentioned unemployment and how, in your view, if unemployment went down to low teens or low double digits by the end of the year or the beginning of next year, that would be a positive sign. Do you have any probabilities, or do you have any forecast about how likely that might be?
Yep. So I would say, our base case forecast is that the unemployment rate finishes the year somewhere between 10 and 12%. And I'm relatively confident in that forecast. I would say that there's probably a 50%, if not slightly higher probability that ends up occurring. You know, as I mentioned earlier, the big risk from where we sit with respect to the labor market has to do with this potential for a second wave of infection. Because if we all do get forced back inside for another period of social distancing and self-quarantining, that then extends the amount of time that small businesses are shut down, and likely leads to, you know, an increase in the number of bankruptcies and just businesses that shut their doors and never reopen on the other side of this. I think this is what's so important is the financial crisis was an S&P 500 problem, right? The financial sector was a huge share of the equity market, but a relatively small share of employment. Now, there were significant knock-on effects with respect to home ownership and credit and so on and so forth, but what we're dealing with today is much more of a Main Street problem, right? It's small businesses that are being impacted. It's local employment that is being impacted. And the longer that these businesses are shut down, the lower the probability that they come back online. And so I will say that, you know, our more medium-term view on where we finish the year really hinges on the potential for case growth to remain contained here over the course of the next couple of months, so that things can reopen in a way where businesses are able to get their legs back underneath them, and we don't see that longer term, more significant structural damage done, which then would impede any further recovery in 2021 and beyond.
Great, thank you, David. Somewhat of a related question. So as of April 30th, it seems as if the average pension fund is down about 10% in terms of returns. What is the likelihood of ending the year, the calendar year, at zero or maybe even slightly positive?
So, you know, the way that I think about it is, I would say that there is a decent chance from where I sit that at some point this year, pension plan returns will be back to flat. Now, I'm not necessarily sure that will coincide with the end of the calendar year, but the way that I'm thinking about this is, I think that the gains you've seen in fixed income over the past couple of months will likely be maintained. I'm not looking for a big sell-off in bonds over the course of the next couple of months. So with that as the view, excuse me, a lot obviously hinges on what happens to the equity market. And I do think that, you know, again, this rally is a bit more durable than a lot of people want to give it credit for, but I do foresee a pullback between now and the end of the year. You know, I don't think we need to see down another 20%, but we could easily see the equity market fall by 10% if it got some negative news. So, you know, depending on when that falls, that will determine whether we get back to zero at the end of this year. But I do think that in general, we are not going to retest the lows in the equity market. And I think that, you know, the bottom line here is that we're probably going to chop around in a range of, you know, kind of call it 3,200 to 2,800 on the S&P, while we get more information around what is happening in the economy and the success or failure of reopening. And you know, depending on where we sit in that range, that will dictate whether or not we finish the year with pension plans back to flat. But again, I think the important thing is that the fixed income gains are sustainable, and the equity volatility should be transitory. You know, absent a big second wave of cases, I don't really see, you know, a meaningful and sustained drawdown occurring within equity markets, and so that should help defend the returns that have been clawed back over the course of the past, call it, you know, 8 weeks or so.
Great, thank you, David. And given our time, probably the last question. So you mentioned both the fiscal policy as well as the monetary policy. Given both, how worried are you relative to debt and GDP on the fiscal policy side and inflation on the monetary side?
Yep. So, you know, on the debt issue, I kind of alluded to it earlier. I think that for the most part, it's about the least dirty shirt. And if everybody's increasing debt levels, I think that, you know, if we're at 130 and Europe's at 150 and Japan is at 300, you know, it's still very much a relative game. I do think that debt levels will weigh on growth longer term. I understand that there's a huge human element to everything that has gone on, but as an economist, I do find it a bit frustrating to see trillions of dollars of stimulus deployed to really just plug an income gap or a cash flow gap, rather than being used for potentially a more productive resource. So the debt level, the debt growth, I do think is going to weigh on overall economic growth longer term. And then the inflation issue is really an interesting one. Short term, I don't see a risk that inflation picks up. And I think that longer term, inflation remains muted because of the debt build that we've seen around the world. But in the medium term, I do worry a little bit about inflation picking up. Look, if demand comes back at a time where liquidity is still sloshing around in the economy, that could prove to be inflationary. And I'm not necessarily suggesting that we're going to see inflation to the tune of what's been observed in Venezuela or Argentina or places that have true inflation problems. I think it's always important to think about inflation relative to expectations. And with investors and consumers looking for about 1.5% inflation over the next 5 to 10 years, if all of a sudden we saw inflation start printing at 2.5% or 3%, that could have the potential to undermine expectations and subsequently lead to a shift in both consumer and investor behavior. So, to me, debt is going to weigh on inflation and weigh on growth longer term, but there is a bit of a window here in the shorter run where inflation could pick up if the stars were to align in a certain way.
Great. Thank you, David. Thank you for your great presentation, your willingness to share your time and expertise with us. And let me close by thanking everyone in the audience for joining us today. On Thursday, we will have our next webinar entitled Preparing for the Impact of the Pandemic on Your Pension Plans. David, have a good day. Thank you, everyone. Take care.
Thanks, everybody.